So far, we've gone over the different types of investment options you might see at a bank. Things like GICs, stocks, and mutual funds. We've also discussed some rules to keep in mind as you approach investing. As we mentioned before, our favorite investment option is one that is low risk, but provides medium to high rewards. Remember index funds? They're a type of mutual fund that imitates certain stock indexes, hence the name. Now hold up, what do we mean imitate stock indexes? Here's an example. In Canada, we have one main stock exchange, which is the Toronto Stock Exchange, or the TSX. You can go on Wikipedia right now and look at a list of stocks that are traded on that exchange. You can't actually buy the TSX, but some banks have created a fund that is very close to holding all of the stocks listed within the TSX. There are funds that mimic other exchanges like the S&P 500 and the NASDAQ. Because index funds represent the stock exchange and the stock exchange composition doesn't change much, index funds are what's known as passively traded. On the other hand, you have mutual fund managers who are actively buying and trading stocks to get better returns. They're trying to beat the market.
Buy! No, buy! No, buy! Sell! Sell!
These mutual funds are actively traded. So, with passively traded funds, the fees associated with them are much lower, usually less than 1% of total assets. Actively traded mutual funds hover around the 2% mark. But wait, 1%? 2%? Of what? These fees are asset-based, meaning it's a percentage of what you have invested. This means that if you have $10,000 invested in an index fund, you're paying $100 a year in fees. Compare that with paying $200 a year on a 2% fee mutual fund. Index funds are recommended by most billionaire investors, such as Warren Buffett. Through statistical data, they perform better than most mutual funds offered to you by your financial advisor, yet charge significantly less management fees. Here's a fun fact. 96% of all professionally managed mutual funds don't beat the stock index. That means you have a 4% chance to beat the market when you choose a mutual fund offered to you by a financial advisor. Let's imagine you went to the casino to play blackjack. The goal of blackjack is to beat the dealer's hand, to get as close to 21 as possible without going over. If you get 2 face cards right off the bat, you have 20 points, which is a great hand. However, if the idiot inside you says hit me in hopes of getting an ace, you only have an 8% chance of getting one. So think about it. You're 2 times more likely to get an ace in blackjack than you are to outperform an index with a mutual fund. Why would you consider putting something so important as your life savings into something with such a low chance of success? We're not saying you'll lose money in mutual funds, but the index, and more specifically index funds, have proven to perform substantially better in the long run in both market booms and crashes. So why do banks promote mutual funds so much?
Hi, sir, are you interested in our mutual fund? It's a really great deal.
Well, remember that you're paying a really high fee to hold those mutual funds because banks are a business too. Your financial advisor becomes a salesperson when they recommend funds for you because they're being told by their manager to promote certain funds. So be sure to do your research, and in the later videos, we'll reveal how you can ask the right questions to your financial advisor. Along with stock index funds, there are bond index funds as well. These follow the same concept in that the fund will have as many different types of bonds in it as possible. In our next video, we'll tell you exactly how to craft the perfect investment portfolio and manage it in the long term. Thanks for watching. If you're new here, click subscribe below. Also, join our email list at youngguysfinance.com. Keep going.
Keep going.
I don't know how much more I can do.
Keep going.
No,
Yes,
sell,
yes, do this,
sell,
do that.
buy, buy, buy.
Mutual fund.
Also, join our email list at youngguysfinance.com.
Boom, boom, boom.